Today we're going to take a look at the overall taxation of foreign investors in the United States. We're going to look at their income tax issues when they come here. We're going to look at their estate tax issues because there's both there's similarities in the income tax issues and differences, and there's big differences in the estate tax issues. So let's first define the foreign investor. The foreign investor is defined for tax purposes as a non-resident alien individual. This is a non-U.S. citizen and an individual who is not a resident alien. When somebody becomes a resident alien for U.S. income tax purposes, they actually pay the same income taxes that the American citizen does. Non-residents have a whole different situation. We're also going to define a foreign corporation because we make use of foreign corporations in part of the tax planning for non-resident aliens. A foreign corporation is any corporation not formed in the United States or under the laws of the United States or any state. And Washington, D.C. includes a United States jurisdiction. Now, a resident alien who is taxed like a U.S. taxpayer, they pay income tax on their worldwide income. They pay an estate tax on their worldwide assets with some major exclusions that we'll talk about. And resident aliens can be subject to paying a gift tax, also with major exclusions before they actually run into the tax. Now, non-resident aliens are under a different tax pattern. When it comes to income taxation, they pay on their United States source income. And we'll look at what we mean by United States source income. And in rare occasions, they might be subject to tax on their foreign source income under certain circumstances. When we look at their estate tax, the non-resident alien pays an estate tax only on United States situs assets. And we'll look at what we mean there in more detail also. The gift tax differs a little. Under the gift tax, it's real and tangible personal property is subject to a gift tax, and that exempts shares of stock, which are intangibles. So gifts of shares of stock are not going to be subject to a gift tax. However, they will be subject to an estate tax. Now, the last thing we're going to look at here is a very special tax that applies only to foreign corporations. It's called a branch tax. We'll discuss it. We'll discuss why it's typically something that you don't really worry about, but you do have to plan around it. So, how do we determine the difference between a non-resident alien and a resident alien? I mean, they both look the same, and the determination is based upon what special status an individual may have, and how long an individual may stay here in the United States. Now, we have three categories of where residents become resident aliens and can be subject to U.S. estate tax on their worldwide income. The first one is if they have a permanent residency status, which is also known as the green card. The card that gives you permanent residency status does happen to be a green card, and that's kind of the way it's usually referred to. The next way that somebody becomes a United States tax resident without being a citizen and without being a permanent resident is if you're here too long. We're going to look at what's called the substantial presence test. If you're here with a substantial presence, meaning a certain lengthy time period, you're going to be taxed as a U.S. taxpayer, even though you're not a permanent resident and you're not a citizen. And the third way someone can become a U.S. taxpayer who's not a citizen is by voluntary election. And this is typically with people who are married and they're over here and they may want to file joint returns and things like that. Now we have two ways that people can be over here for a fairly lengthy period of time and still not be taxed as U.S. tax residents. We have the two exceptions. One is called the closer connection exception, and we'll describe what we mean by that. And the other is if a taxpayer is from a country that we have a tax treaty with, and we have tax treaties with well over 50 countries, but a taxpayer who's here and is governed by a tax treaty can actually spend much more time here than a non-treaty person and still not be considered to be a tax resident for U.S. tax purposes. So we're going to look at how all this works, and then we'll take a close look at how the non-resident alien is taxed. Now, the first, we talked about the green card, and which is permanent residency. The next way that one becomes a U.S. taxpayer, a U.S. resident for tax purposes, is what we call the substantial presence test. And what that is when somebody is here for a lengthy time period, and the way it's measured is you look at the year in question. So if we have somebody and we're trying to determine whether they're a taxpayer in the year 2017 because they've been here a certain time period, we have a formula for this. We look first at how many days have they been here in 2017, and we count each one of their days in 2017, which is what I call the measuring year. We count each one of those days as 100% being here. Next, we go to the year before the measuring year, 2016. And we're assuming in this model that this taxpayer on the left-hand side, the one that is continuing to be a non-resident alien, that this taxpayer spent 120 days in the U.S. for each of 3 years. Now, in the year 2016, the taxpayer spent 120 days. However, in determining how long this taxpayer stayed here, for purposes of the year 2017, the year we're trying to determine whether they are a taxpayer, you only count the amount of days here in the U.S. as 1/3 of a day. So you'll see from the chart that if you're here 120 days in 2016, it means the amount of time counted towards your residency period is only 40 days. Then we go back to the second year before the measuring year. We go back to 2015. Now, here in 2015, the taxpayer spent 120 days also. However, for purposes of our formula of determining the amount of days spent here, this counts only as 1/6 of a day. So what you'll see on the left-hand side is that in the year 2017, when you add up all of the days counted as residency days on the far left-hand side, it's only 180 days here. Well, so long as a taxpayer under this formula is not in the United States for more than 182 days, they continue to be considered non-resident aliens. And that's the non-resident alien that we will be most focused on when we start to discuss what are the tax consequences to a non-resident alien, both income tax and estate tax. The right-hand side, let's go through that same exercise again. You'll see on the right-hand side how somebody became a resident alien by spending too much time here. In the right-hand side, we have someone in 2017 here for 120 days. That's counted towards their residency days. In 2016, they're here for 150 days. 1/3 of each day is counted towards their residency days. And in the year 2015, they're here 120 days, and 1/6 is counted towards residency. You'll see on that side of the equation, on the right-hand side, you have a taxpayer who's been here for 190 days, more than the required 182 days. And this taxpayer is going to be considered to be a U.S. tax resident, and the taxpayer is going to pay tax on the taxpayer's worldwide income, just like Americans. Now, we have another category of taxpayer that I want to pay some special attention to, because this is a very unique benefit. Students, full-time students, can spend much more than 182 days in any given year here in the United States without being tax residents. They need to have a student visa, and with that student visa, for a period of 5 years, they can be here as long as they want, and students will not be taxed on their worldwide income. They will only be taxed if they earn any kind of income in the United States. Now, this student visa is prone to abuse because you can bring family members with you. So you can have a family member who is coming here as a student, a wife is coming here as a student, and her husband is allowed to come here, and her husband is not going to work in the United States, but her husband has holdings all over the rest of the world. And those holdings continue to produce income. Well, because the husband is protected under the student visa, the couple can stay here under the student visa for a 5-year period, and with exceptions, even extended. And the husband's income is not going to be subject to U.S. income tax because it's made outside of the United States. So that's a very unique visa. We're now going to discuss the two ways that I talked about how non-resident aliens can spend a longer period of time here than the usual period of time, and still not be subject to tax as U.S. taxpayers. And they fall into two categories. The first category is what we call the closer connection exception. And what we're talking about here is that even if a taxpayer is not governed by a treaty, they can spend up to a maximum amount of 182 days each and every year in the United States without being a U.S. taxpayer. Now, in order to qualify for this, you have to have what's called the closer connection, and this is termed the closer connection exception, which is an exception to the general rule of residency. The closer connection exception basically means that if you are here for 182 days and you still have your center of life is in a foreign country, if you have your family there, if you have your business there, if you have your house there, you will have a closer connection to this foreign jurisdiction, and with that you'll be allowed to stay up until 182 days. The next exception is the exception that's provided by the U.S. tax treaties. And we have, as I said, tax treaties with many, many countries. Those tax treaties all basically do what is called a tiebreaker rule. And under those tax treaties, a person can actually be in the United States for more than 182 days and still not be a U.S. taxpayer and not be considered a U.S. tax resident. And the way the tax treaties work is to basically have what they call a series of tiebreaker rules, which is, first, where is the taxpayer's home? If the taxpayer's home is in the foreign country and the taxpayer is here in a motel or a hotel for 210 days, let's say, but it's really not their home, it's a transient situation, then you continue to be a non-resident alien because your home was not here. Let's assume you have a home in both places, which is often the case with a lot of non-resident, a lot of alien individuals. If you have a home in both places, then you look to see where is your center of vital interests. That means, do you have a home, a business, and family in your home country, and only a home in the United States, or only a home and a branch of a business in the United States? Or do you have a home in the United States, a business in the United States, and family in the United States, and have them in both that same group in both places? If they're in both places, then you have a tie again. But if either one of those places you have a home and family and a business outside the U.S., and you have only a home and some family members inside the U.S. and no business, then that tiebreaker means that you are still a non-resident alien. You don't have a tie that says, oh, you're in both places in similar capacity, but if one rules over the other, then you're going to remain a non-resident alien. If you've got most of your tiebreakers, if you have a home in both places, a business in both places, and no family outside the U.S. and family in the U.S., then you have the tiebreaker ruling that you're a U.S. taxpayer. And finally, if both tiebreakers are a tie, both the home, then the center of vital interest, if that's a tie also, then you do what is called, what is your habitual abode? And that basically, under case law, comes down to where did you spend the most time during the year? So if you have a tiebreaker on everything, the third item you get to is if you spent 100 days in America and you spent 90 days in Turkey, and that's where you're from, and you spent the rest of your time traveling in different places all around the world, then the tiebreaker is going to be you now are a U.S. taxpayer because this is where you spent the most days. Now, if we have an equal habitual abode, so each one of the three tiebreaker rules come out to be a tie, then we go to the authorities of both countries, and those authorities try to figure it out as to who owns you for tax purposes. So that's the kind of scenario of what the U.S. taxpayer, what the alien U.S. taxpayer looks like and doesn't look like. So now let's look at the tax pattern that applies here. And what we're going to see is, first of all, that we have to look at the source of income rules. Because if someone is a non-resident alien and they're earning their income outside of the United States in their own country, we're certainly not going to assert a tax on income that they've earned outside of the United States. So we have to distinguish with non-resident aliens between U.S. source income and foreign source income. And we're going to identify U.S. source income and foreign source income. and also the deductions that relate to that U.S. source income or foreign source income. If it's U.S. source income, there's a good chance, depending on the type of asset, the foreigner will be taxed on gains and income that they make from their U.S. source income. There are several exclusions, though, even if it's U.S. source income, and we'll get to that. If they're making foreign source income, typically they are not going to be taxed on their foreign source income. Maybe under certain rare situations, they may also be taxed on the foreign source income. Now, the difference between a non-resident alien taxpayer and an American taxpayer also is a difference between the taxes on passive income versus active business income. And the distinction is that passive income, which would be interest income, dividends, income like that, that's not income from a trade or business, that type of income is usually taxed on a flat rate. Now, the reason for this is that the United States really can't keep track of interest income and dividends that are being paid to people overseas, to foreigners. So therefore, what the United States has done is they've said, well, we're going to assert a tax on interest income from the United States and dividend income from the United States and other types of passive income, royalties, for example. But we're going to make the American person who was supposed to pay you the tax the person who needs to withhold your tax. And that leads to the term a withholding agent, because there's no other way to collect these taxes unless you put someone in the United States who's in charge of paying the income out and make them the first people who need to be concerned with it. So the first people who are on the firing line that need to withhold income on certain passive expenses are the people who are paying that income. And the United States will hold them responsible if they don't collect that income. So there's a lot of people who are really not aware of this. A lot of it goes unnoticed, but it's a trap for the unwary. Now, as opposed to passive business income, we're going to talk about active trade or business income. People who come here and actually get in the business here in the United States, not just making passive income such as interest or dividends. And here we have the same tax rates for the taxpayer, the foreign taxpayer, that we do for the American. A foreign corporation that's doing business here will pay a 21% corporate tax rate like the Americans pay. And now we're now talking about the changes made under the Trump tax bill. There is now, this is an updated version of what's going on. There's a 21% corporate tax rate now. As an individual, there's graduated income tax rates from 10% to 37%. They don't go up to 39.6 anymore. And these graduated rates are applicable to what we call effectively connected income. In other words, income from the United States from a business source that is connected to the United States. Now, there's certain types of income that under the new Trump tax bill, you're still going to have the 21% tax rate for corporations that are doing business here, whether they're foreign corporations or U.S. corporations. But you also have, as to certain types of income now, a flat 20% tax rate on individuals with those certain types of income. And that's a real advantage that is going to be drawing a lot of people here to the United States to take advantage of these low tax rates for doing certain kinds of business in the United States. So that's the basic tax rate pattern. Now, they also, if you're here with the United States treaty, then there are some differences. Under the treaties, passive income, the withholding tax on passive income is generally not 30%. It can be anywhere from 0 typically to 15%, because the treaties are set up to permit people from both countries to have an advantage when they come to each other's country as in the business world. So now we're going to look at the exceptions that make U.S. taxpayers different than foreign taxpayers. We've looked at the similarities, which are the tax rates, the fact that there's on U.S. tax source income, the same tax that Americans has. But now let's look at the exceptions. The first exception is that most assets in the United States are not subject to the capital gains tax when a foreigner sells a capital asset at a profit. Now, the reason for this is that there is no way to police these assets. If you have a foreigner that owns General Motors stock in Germany and they're selling it in Germany, how are you going to know what they bought it for, what they're selling it for? And so what we essentially do is we exclude a lot of different assets from paying the capital gains tax. So that's one difference that and it's a big difference that allows alien individuals a very nice advantage. Now, they are subject to tax, however, on their real estate income, and they are subject to tax on certain other types of income. But for the most part, the capital gains tax is not going to apply to foreign individuals, and generally it's not going to apply to foreign corporations either, based on those same rules. So that's a plus for the foreign investor in the tax world. Now we're going to look at a big minus. The minus is that an alien individual who is here as a tax resident, and we're going to look at this in detail a little later, because there's a difference between a U.S. tax resident for estate tax and for income tax. But for the moment, let's assume we have an alien individual who is here as a resident. That individual who is here as a resident is going to have an $11 million exclusion, like the U.S. taxpayers have now before having an estate tax. However, if that alien individual is here as a non-resident, they are not going to be able to take advantage of the exclusions. And if, for example, a non-resident alien buys a piece of U.S. real estate for $100,000 and sells it 2 years later for $1 million, that non-resident alien is going to pay a tax on those capital gains. Worse still, if the non-resident alien dies while owning that piece of property, they are going to have in their estate $1 million asset, and the only exclusion they're entitled to is $60,000. Consequently, if you come here and you buy a U.S. situs asset, which includes real estate, it includes stocks and bonds, and tangible property, you could come here and have as high as a 40% tax just because you died here on, in our example, $940,000. So we will pay attention to how we tax plan for foreigners who come here and are exposed to estate and gift taxes. Now, the other tax that is we'll take a look at, but this tax is not typically paid. If a foreign corporation comes here and does business in the United States, they will be taxed exactly like an American corporation. They'll have their 21% tax rate. However, if they do not distribute dividends out to their taxpayers, which could be incur a second tax, or if they do not reinvest their cash in the United States, and they keep a huge liquid stash of money here, the United States wants to force a foreign corporation to either invest here or pay a tax when you pay a dividend, distributing money out of the United States. And so if you don't do either of those, there's a tax called the branch profits tax. And that is a 30% tax in addition to the income tax on cash that's held in the United States that's beyond a reasonable amount of cash. You typically will not see that tax being asserted because the foreign corporations that come here, most of them are here because they're from countries that we have treaties with, and those countries don't typically apply the branch tax or have America apply the branch tax. And the other corporations that are here are usually aware enough of the branch profits tax where they will be distributing money one way or another, or reinvesting it, or liquidating and getting their cash profits out as soon as they earn them. But you still have that principle of the branch profits tax that a foreign corporation only can be subject to. So we have defined the foreign investor the non-resident alien individual, the foreign corporation. We've defined the sources of income that they could be subject to, which is basically U.S. source income, passive income, interest and dividends, and U.S. source income that's active income. We've looked at the treaties and how the treaties affect everything. And we've looked at some of the exceptions to the rule, which are the U.S. real estate, which is going to be taxed one way or another, and the branch tax, which one may run into. The next slide is just an example of the branch profits tax. If it's asserted, you can see down there at the last column, before we calculate profits, the branch profits tax can be a very, very significant tax. And it's a tax asserted on the taxable income after all of the city, state, and federal income taxes have been deducted. So now we are going to take a closer look at the source of income rules so that one will be able to define what type of income they're dealing with and be able to, if they need to pay tax on this, go ahead and pay taxes and not get caught up in the United States tax problems. So we'll take a look at the source of income rules. First, what are U.S. source income? And next, what is foreign source income? The first we're going to look at is the U.S. source of income. Now, compensation for personal services. People who are working in the United States and receiving compensation for their personal services in the United States are U.S. source income. If it is a foreign person working outside of the United States that's earning only foreign source income, they're not going to be subject to that. It's only foreigners who are here that are earning U.S. source compensation income for personal services. Rents and royalties. Rental income and royalties is sourced where the property is. So if you have rental real estate in the United States, it's going to be U.S. source income. If you have a patent on a licensed property here in the United States, that's going to be U.S. source income. Real estate is U.S. source income, whether it's rental income or sale income, if it's here situated in the United States. Personal property is typically sourced at the place of sale. And that gets into the whole issue of where did title pass to the buyer? Wherever title passed to the buyer is the place of sale. However, there's been so many games played with this one definition on personal property that there's a lot of exceptions and complexities to make sure that people are not making end runs around the taxes that should be paid on the sale of personal property. Interest income. Interest income is U.S. source income if the debtor is a United States debtor. Typically, interest paid by foreign residents is foreign source income. The same goes with dividends. Dividends paid by U.S. corporations are going to be U.S. source income. Dividends paid by foreign corporations are typically going to be foreign source income. However, again, there's exceptions to these rules because you may have foreign corporations working in the United States and other types of foreign entities in the United States. And this gets to be on a case-by-case basis, typically. Now, there's also a set of rules for property that's partially within and partially without the United States. And this is like income from transportation services. Again, you have your exceptions here, and there's a case-by-case approach to the partially within and partially without rules when it comes to source of income rules. Now, when we look at the source of the deductions will generally follow the income that is related to those deductions. But again, you can get certain exclusions here, and you really have to go on a case-by-case basis when you're talking about deductions related to income earned by foreigners, as to whether that's income from United States sources that are going to be typically taxable, or income from foreign sources, and how the deductions are related. We've already talked about the tax treaties, but I'll run through them as just to recap. The tax treaties will reduce or eliminate some of the tax rates on certain types of income for foreign taxpayers. Sometimes they will overrule the source of income rules. They may exempt certain kinds of income that would ordinarily be taxed, and they may provide for tax credits between countries to be used a lot more efficiently. Now, what we're going to do now is, now that we see the taxes of the United States on foreigners and foreign corporations and non-resident aliens, and we've seen the rates, we've seen the types of income that they have to pay tax on, we're going to take a quick look at all the different ways that a foreigner can invest here. And each one of these have different advantages. And you will typically select the entity that you want to use depending upon the complexity of the United States source income, the size of the United States source income, and several other factors. You're not going to want to spend $10,000 to put a structure together to save $500 a year on a few dollars of interest income that's coming out. So we'll see these different available entities, how they're used, what their advantages are, what their disadvantages are. Now, the first item is individual ownership. It's really not recommended to come here as an individual and buy a U.S. asset. Yes, you will have a lower tax rate, starting at 10%, going to 37%. You will have no branch tax because you're not a foreign corporation. But you will have U.S. income and capital gains taxes that also might be in the lower tax brackets. Now that's good from a tax standpoint, from an income tax standpoint. The disadvantages, though, I believe outweigh the advantages. Number one, an individual who invests here is going to be subject to that horrendous estate tax, where if you have U.S. situs assets that are very valuable, you'll be able to only subtract $60,000 before you start paying a large estate tax on those assets. The same with gift tax. The U.S. gift tax is very similar to the estate tax, and it taxes gifts. It's a little different. It has some exclusions, but you transfer the wrong asset, and you're going to be subject to a U.S. estate tax as an individual. Probably worst of all, if you're here as an individual, you're going to have unlimited personal liability. If you buy an apartment house here, rent it out, don't have any insurance, somebody trips and kills themselves, and you're the personal owner of that apartment, you could have $1 million lawsuit, and that's you personally. And the other disadvantage is your ownership of whatever you buy here is going to be disclosed because you're going to be on the deed. So that's not really a highly recommended entity. The next entity up the ladder is the limited liability company. Now, the limited liability company has all the same attributes as an individual investing here in the U.S., except one. And that attribute is the fact that at least you will not have personal liability if you are investing here in the United States through a limited liability company, because the liability will only be on that company, and it will not be on you personally because you're separated from the damage but through a corporate or through a different entity, and you're not there personally. So that's the next entity that we can use. The third entity, which is very much the same as the limited liability company, is individuals who might come here and foreign corporations who might come here and are going to form a partnership. The partnership is good because instead of putting everybody in one entity and having that one entity earn taxable income, the partnership allows you to spread out over each partner whatever income was earned in the investment, so that the partners will typically be down in a lower tax bracket because you haven't piled their income one on top of the other. Except for this particular break, the partnership has all of the same disadvantages and advantages of the limited liability company, which still leaves you with a estate tax exposure, gift tax exposure, no limited liability exposure, and a good tax bracket if you're earning less income because you've spread it around to all of the partners. The next entity is to go into a United States corporation. Now, here's where we start to get a bit more advantages, but it's still not the be-all and the end-all. If you're in a United States corporation, that corporation is going to pay a 21% tax. There will be no branch tax because it's a U.S. company, not a foreign company. There will be no gift tax on the transfer of shares. There's an exclusion for gift tax. There'll be no personal liability because the corporation will separate you from personal liability. There'll be no disclosure of your ownership because you own shares in a company. You don't own the asset directly. And a U.S. corporation is not an expensive entity to set up. The downsides are, again, the major downside is that you will be subject to the estate tax and the gift tax if you pass away. While you didn't have to pay a tax on transfers of shares while you were living that you made as a gift, gift taxes when you pass away and in your estate are all going to be subject to the estate tax, and that could be a very high tax. We now come to the entities that provide much more tax planning advantages. And this is a foreign taxpayer who opens a foreign corporation. Now, typically, this will be a foreign taxpayer that will go to a country to open a corporation, and it'll be a country that really doesn't tax you for any income you earn outside of that country. I've found that each jurisdiction throughout the world has its own favorite places. The Chinese go to Hong Kong. Form a Hong Kong company, no tax. The Arab countries, almost all the Arab countries, have no income taxes. The Europeans will go to the Isle of Man. They used to go to Liechtenstein, but I think those days are over. A lot will go to the Cayman Islands. The Latins will go to Panama. They'll go to Belize. Every jurisdiction, I believe Singapore goes through Malaysia. The Russians go to Cyprus. And so every country has its outlet, so to speak, where investors can go and form a foreign corporation and use that foreign corporation to come here to the United States and invest. Now here, the first advantage is, in the old days, a foreign corporation could be taxed as high as 35%. With the new Trump tax rules, foreign corporation is only going to pay 21% here. Furthermore, a foreign corporation is going to protect you from having an estate tax, because a foreign investor that owns shares in a foreign corporation, the United States has no jurisdiction over that. We have nothing to do with it. So we can't charge an estate tax. And we can't charge a gift tax either for the same reason. The disadvantages here are, as I mentioned, there could be a branch tax for not making distributions. The foreign corporation is going to be a little bit more expensive to establish. And if one doesn't know what they're doing, and they start to declare dividends without having planned for this, they may have a double tax on the dividend that they pay out that represents a sale by the corporation that made a U.S. profit, and then a U.S. dividend that's paid out of those U.S. profits. And there can be U.S. dividend taxes on that. And there are ways to deal with this. And that's some of the tax planning we do. Now, the next type of entity that one would use is also a foreign corporation, but here it will be a foreign corporation in a country that we have a treaty with. Now, so many times you will find that the people in countries that we have a treaty with will not open a corporation in their home country, because if they open a corporation in their home country, they may wind up paying taxes on their U.S. income in their own country. So it depends on the country as to whether it's going to be useful, if you're in a treaty country, to open a corporation there. But the advantages are great. You get the 21% tax rate. You have no gift tax on transfer of shares. They're foreign shares. U.S. has nothing to do with them. No estate tax. No branch tax, because the treaty eliminates them. And if you pay dividends and interest, having a treaty, a country that we have a treaty with, the dividends and the interest is all going to be taxed at a much lower rate than 30%. There's also going to be limited personal liability, because you're in corporate form, and no disclosure of your ownership. The disadvantages are really not much more than what would typically be. You pay tax on your capital gains. You pay tax on your ordinary income. That corporation will pay tax. And the company may be a little more expensive as an entity than any other company. The next one we're going to look at is when you get very, very sophisticated. And that is what I call the tiered corporate entity. And what that means is one will open a foreign corporation so that they will not have the estate and gift tax. They'll not have to worry about paying the U.S. estate and gift tax. And then they will open a United States corporation that is owned by that foreign corporation. And that allows them to eliminate any exposure to the branch tax. So you have, by having a tiered corporation of a foreign corporation that's the 100% owner of a U.S. corporation that's investing in the U.S., you have the advantage of the 21% corporate tax rate, having no estate tax, a lot more flexibility for your income tax planning, no gift tax on the transfer of shares, no branch tax, and even more remote disclosure of your ownership in the business, which to many people, this is a big item, non-disclosure. There's in many countries, people are very afraid of kidnappings and those kinds of things that can happen when people know you have a lot of money. So this is what I call the Rolls Royce of tax planning. And it's a more separate entity. It's a disadvantage. You're forming two corporations, not one. You may have some dividend issues that are typically solvable, but there's the potential for having a double tax when there are distributions from the U.S. company. And that's pretty much it. So now we're going to switch over to the estate tax field. We've covered the income tax issues. We have covered the taxation. We've covered the entity choice. We've covered the planning aspects of this. We've covered the source of income rules. Now we're going to look at what happens to a foreign investor under the U.S. estate tax laws. Now, we don't have all these rules of residency when we talk about the foreign investor for estate tax purposes. It doesn't depend upon how much time you have spent here. Whether you're a U.S. tax resident for estate tax purposes is whether you are domiciled here. Are you here with no intention of ever leaving this as your permanent home? That's the definition for estate tax purposes. So if you are not domiciled here, then you are a non-resident alien for estate tax purposes. And as I mentioned, a non-resident alien for estate tax purposes is an onerous position to be in. The estate tax may not be a factor if you were in a country that the United States has an estate tax treaty with. Those treaties will generally provide for either no estate tax or a much lower percentages of estate tax on the nationals of each of the other countries. However, we don't have many estate tax treaties at all. So the chances of you being from a country there where we do have an estate tax treaty are very slim. The other way to deal with the estate tax is if you're in a country that has a higher estate tax than the United States does, and that country would include in your estate, for their purposes, your U.S. assets. If you're going to pay a higher tax in your home country for estate tax purposes and a lower tax in the United States, you really don't have to worry about it, because what will happen is you will get what's called a tax credit. And whatever you spent in your home country as an estate tax for this, you will be able to apply against the United States tax, estate tax. And that'll pretty much, as a general rule, it'll pretty much wipe away any U.S. estate taxes. Now, we're going to talk about just a couple of estate tax plan of U.S. income tax planning techniques. And there are several different ways to make the best of U.S. taxes. And we're going to have just a kind of a quick review of three of them. Now, the first one will be the fact that a non-resident alien can come here to the United States and open up a corporation in the United States. Or they can come here with a corporation from a foreign jurisdiction. And they can open their business, make their profits in that business, and if they don't distribute profits and just keep some of those profits in, let's say, their United States corporation, instead of paying a dividend out that would be taxable, at any point in time they want, they can liquidate their corporation that they have here in the United States. When they liquidate that corporation, and that corporation pays all of its tax on any of its income, they can distribute all of the cash out of that corporation without having any second tax whatsoever. So the opportunity of having a single tax is front and center here in the United States, and there's several ways to manage that. The next item that we're going to discuss, which is to me the maximum tax planning tool, and this is the tax planning tool of the portfolio loan. Now, let me explain the portfolio loan. As a general rule, if a foreigner opened a company in the United States or made any kind of investment in the United States through a partnership or a trust, it doesn't matter. If that foreigner loaned money to the corporation that, let's say it's a U.S. corporation, if they loaned money to the U.S. corporation to finance their investment, so they bought shares in the U.S. corporation, they owned the U.S. corporation, and they loaned money to the U.S. corporation. Interest income on that loan is going to be subject to a withholding tax. If it's a treaty country, it may be 5% or 15%. If it's non-treaty, it's going to be, like we talked about, a 30% tax if they pay interest out. Now, the interest is deductible. It's an expense of doing business. So on the one level, they're getting a deduction, so their taxes are going down. But on the other level, they are being taxed on the interest that reduced their profits. And that is typically a flat tax of 30%, and it's going to be higher than the tax on the operating profits. So the United States saw that loans are going to be very important to people, and that this could lead to a mess, because if somebody's borrowing money from a bank in Russia and paying the bank a percentage on the money that they're borrowing, and then they're paying a 30% tax on whatever interest they get, they're stuck in the middle and wind up could be losing a lot of money. So the United States said, okay, let's make lending easy for the foreign investor. However, let's make it easy for the foreign investor, but let's not make it easy unless they own only a small piece of the deal they're investing in. Because if they own the whole thing, then and we make it easy for them to borrow money, they're going to have a tremendous advantage over the Americans who would be wanting to make the same investment. So they came up with something called a portfolio loan, which means if you are in a deal and you own essentially less than 10% of the deal, if you're in a corporation and you own 9% of the shares of stock, if you're in a partnership and you own a 9% interest in the partnership, if you own less than 10% and you want to make an equity contribution for your 9% and make a loan in addition and get interest income, that interest income is not going to be taxable to you at all, which means you are going to be able to take a deduction for an interest payment off of your profits in the United States and pay yourself interest and not have any tax to pay on that interest that you used to make a deduction in the United States. It is a valuable, valuable tool. You have to fit into certain categories. You are not going to be able to say to your mother and father and grandfather, oh, well, let's go into this deal for 36%, but we're all each going to own 9% of the deal, because if within certain degrees of relatives, and if you're in certain corporations and certain partnerships where there's a related interest, they're going to look at that and say, oh, no, you don't have just 9% of this deal. You have 36% of this deal. You're not allowed to get the portfolio loan. But barring those kind of things, the portfolio loan is a wonderful planning tool. The next planning tool, and the last one we're going to talk about, is what's called a like-kind exchange. Now, this planning tool is only available to real estate investors. And essentially what this planning tool does is it says, if you come to the United States and you buy a parcel of real estate, and your real estate goes up in value, and you don't want that same piece of real estate any longer, but you do want to stay in United States real estate as an investor, you're going to be allowed to exchange your real estate where you have a profit in exchange for a piece of real estate at a higher value equal to the amount of profit that you made, and not pay any tax on the gain that you made in that first asset. And so long as you keep exchanging real estate for real estate, you will never pay a tax until you finally make a sale of that asset. So this is a wonderful way of continuing to stay in as an investor and continue to change investments with the market while at the same time not paying any tax on your gains until that point in time, whenever it may be, 20, 30 years from now, until that point in time that you are going to finally sell your assets and realize money, as opposed to another piece of United States property.